Hi, everybody. As Jeanette had said, my name is KC. And for those of you who I haven't had the chance to meet yet, I am an investment analyst on the FlexPath team. So I'm part of the investments innovations team with RPAG. And today I'm here to talk about the target date fit analysis, as well as the TDF Analyzer tool. So just for starters, the tool itself is meant to help you run a seamless report to make sure that the target date fund in a certain plan is suitable, just based on risk. And this is great for current clients to run and make sure that the target date fund is suitable. But more importantly, and what we've seen a lot of feedback from, is that it's a great tool for prospecting as well. Just being able to go to prospective clients and just let them know that you have an analysis to make sure that the target date fund that they're using is suitable and it's correct. That's able to help provide a lot of value. And one thing I'm sure y'all are all really aware, many clients may just say that they want to be in the cheapest fund that may have good reporting or good history. That's really not the most prudent way for selecting target date funds. And really the purpose of that is just because there's been a large increased usage of target date funds. In recent years, target date funds have grown to become basically the most used investment solution. And apart from that, not all target date funds are made equally. So there's a lot of differences among like-dated target date funds that many plan sponsors and plan participants especially are really unaware of. And lastly, we just find that conducting proper due diligence will ultimately help protect plan participants while also helping mitigate fiduciary risks on y'all's end or on the plan sponsor. So next up, I'm going to be showing just some slides that are pulled directly from the Fit Analysis report. These are some slides that we like to show to other investment committees and clients just to kind of drive home why this extra due diligence is needed. And before we get started on that, does anybody want to just try and take a guess as to what percentage of plan participants among all retirement plans are using target date funds?
70?
70? 70 is close. It's actually a little bit more than that. So it's actually 83%. 83% of plan participants among all retirement plans are using target date funds in some way, shape, or form. And just to drive that a little deeper, 59% of plan participants have their entire balance invested into a single target date fund. Also, according to Vanguard, over the last 10 years, the percent of contributions into target date funds, as well as the percent of assets in target date funds, has nearly doubled. So with target date funds really having grown to become one of the most popular investment solutions, and really just the proliferation of target date funds itself, it really begs the question, is this the right target date fund for my client or this prospective plan? Another thing here, if you see, this is over 100 different target date funds that are out there in the universe. We went ahead and just mapped out our glide path. And just from looking at this, can you really choose one and say, this is the target date fund that I want to choose for this XYZ plan? Odds are it's probably not. And the main differences here is really to look at the beginning of the glide path as well as at retirement, and just see what the equity exposure is there. So on the left, you'll see the equity exposure at the start of the glide path. So these are for the participants who are 20 years old, still got 45, 50 years left in their working life. That 25% difference in equity exposure can ultimately lead to be a very meaningful amount during the accumulation phase and is honestly detrimental as to whether or not they'll be able to reach their retirement goals. More importantly, in our opinion, is the equity exposure at retirement. So that'll be at the dotted line. The most aggressive target date fund with the highest equity exposure is at 63%, whereas the most conservative is at 8%. That 55% difference can ultimately lead to extended amounts of risk that some plan participants are really not needing, basically. And scenarios where we see that is basically all market downturns. So here are the range of returns for 2010 dated target date funds during the global financial crisis. So during the periods of November 2007 through the end of February 2009, you'll see best case scenario, the target date fund that performed the best was only down 10%, whereas worst case scenario, the target date fund that had the worst performance ended up being down 51%. One way we really like to instill this image to clients is just to put yourselves in these shoes. Imagine you and your neighbor Y'all are both 63, 64 years old, 1 to 2 years out from retirement, and have your entire 401k invested into this 2010 daily targeted fund. Next thing you know, there ends up being a market downturn, which in this case was the global financial crisis. And your neighbor, just fortunately for them, it was what the plan sponsor had chosen, they would ended up being in the most conservative targeted fund and had lost 10% of their 401k balance. 10% of the retirement savings was wiped away, but with the 1 to 2 years left that they have in their track, it still gives them plenty of time to build back their retirement savings and still retire on time. On the flip side, unfortunately, just unbeknownst to you, the targeted fund that was chosen for your plan, you ended up being down over 50%. So half of your retirement nest egg was just wiped away in that basically year-and-a-half period with 1 to 2 years left and working. It's pretty unlikely, speaking frankly, that you'll be able to have the market rebound in time and get back to pre-global financial crisis levels for your retirement savings. So this is something that happens a lot for plan participants, and they're really unaware of it. If they were to talk to someone and see that they were both in the 2010 data targeted funds, they just wouldn't know that there's such a large difference among different targeted funds. As mentioned, this is something that happens during most market downturns. So this is the same just with the 2020 data targeted funds during the COVID pandemic. So the best performing targeted fund was down 8% in this period, whereas the most aggressive targeted fund had lost 3 times that amount. So back in 2013, the Department of Labor, sent out a target date fund tip sheet to help plan sponsors and fiduciaries choose target date funds for their plans. We went through the full tip sheet and wrote out some bullet points on what we found to be some points of area that they stressed the most. First of which was to align the target date fund with plan participant characteristics. One way RPAG has helped with being able to process this is that we went ahead and assigned a certain risk level for each target date fund. So it's going to be either conservative, moderate, or aggressive. And the way that we did that, I'll touch on in a few slides here with our process itself. And just with that target date fund risk level, you'd match it up with the participant characteristics, which will be found with the fit analysis. So the target date fund fit analysis that you can run in the RPAG portal will help with assigning a certain risk level for the average plan participant that you can use to match up the correct target date fund. The next thing that the Department of Labor says to do is to understand the underlying investments. Excuse me. And as Jeanette had mentioned in the previous presentation, the RPAG portal has the blended scorecard to take a look at what the scoring is of the target date fund itself, as well as the funds that are under the hood. Next up is to review fees and investment expenses. This is obviously just making sure that the target date fund that's chosen for the plan is priced and in line with the expectations of how it's going to perform and whether it's passive or active. Next up is to consider custom or non-proprietary options. This is something that we hold near and dear to our heart at FlexPath, just because I'm sure y'all are all familiar with FlexPath themselves, but we went ahead and made a custom targeted fund solution that employs multiple risk-based glide paths to help kind of combat the issue that we found, which is that one risk level may not be able to encompass all of the plan participants. Over the last 10 years, since FlexPath's inception, we've grown to over 60 billion in AUM, and according to recent sway reports, one of the top 10 targeted fund producers, and that's all thanks to y'all, RPAG members. And so I'd be remiss not to bring that up, so I'll just end the shameless FlexPath plug there and move on. But the last thing from the Department of Labor is to document the process. So the actual fit analysis tool itself will do step-by-step and show how you found that risk level and then how you chose which targeted funds from there. Here we actually have the 3 different risk levels mapped out so y'all can see. Green being aggressive, blue being moderate, and orange being conservative. Generally for the participants that we see that fall into the conservative risk bucket, those will be the participants who throughout their working life may have just been higher income earners and ultimately were able to save at higher amounts, being able to build up their nest egg to where their main retirement investing goal is stability. So on the flip side, there's the aggressive risk posture. For whatever reason they may have had throughout their working life, they may have not been able to save as much as they would have liked to where they would need to take on extra levels of risk to attain that extra growth in their retirement accounts. So here's the actual target date fund risk matrix that we use for assigning a certain risk level. What we do is just take a look at the equity exposure at various points in time, as well as the rate of transition, so the slope itself of the glide path. As I mentioned earlier, the equity exposure at retirement is one of the most important factors that we look at. So that does have a 65% index weighting. 25% of the weighting goes towards the glide path slope, and the other two metrics that we do take a look at would just be the equity exposure at the start of the glide path as well as at the end. So these are basically some of the slides from the fit analysis report that we are able to generate. And before I move on to talk about how to actually run the plan fit analysis itself, does anybody have any questions? All right, perfect. So the plan fit analysis itself is a tool, as I mentioned, in the RPAG portal. And what it does is it assumes the average participant in the plan's risk level. And in order to be able to do that, there is some information that's needed to be obtained from the record keeper. So here's an RFI that we will send to the record keeper, or we can send to y'all to give to the record keeper as well. Alternatively, you can also request the record keeper just to send the most recent plan review. The information on the plan review will be able to help you answer the questions on the actual fit analysis. So once the information has been obtained, you can go ahead and move on to the RPAG portal. In the tools section of the menu at the bottom, there's the TDF Analyzer tool. Once you click on that, this is what the actual start page to the tool looks like. From starters, just on the top left, you'll just put in the report name, so generally just be the plan name and Q1 2024, etc. And the method of analysis would have to be the TDF fit analysis. The custom TDF comparison is basically just going to show a report comparing target date funds minus the actual fit analysis. So once you have that all ready to go, you can go ahead and click start and move to step 1. This is the actual plan fit analysis and the questions that you'll be answering that you received from the record keeper. So here you'll see there's 3 different decision trees: plan objectives, plan demographics, as well as participant behavior. There's 3 yes/no questions for each decision tree, and as you change the answers, the glide path risk consideration at the bottom will change to either be conservative, moderate, or aggressive. And one thing I wanted to mention here, as Reese has mentioned, we are currently in the works of revamping our whole plan fit analysis tool. The test itself is ready to be run manually. We just haven't been able to fully code it into the system yet. So if you do want to use the new plan fit analysis tool, you can reach out to me or anyone who's on your direct FlexPath team, whether it be Kellen or Matt, and we'll be able to take care of that for you. Really the main difference is that instead of just being yes and no questions, we did a little bit more stringent questions and answers. So there's going to be actual numbers and ranges and just more answer choices, just to kind of get a little deeper dive and make sure that the risk level that's shot out is more accurate, more correct. So once you finish these questions here, the RPAG system will automatically average out the risk level for you. So in this case, on the sample, it gave us a moderate glide path as being the best risk level. When you move on to step 2, this is the actual targeted fund series selection. So on this slide, this is where you'll go ahead and choose the different targeted funds you want to show, and the portal automatically shows and filters only the moderate targeted funds. In which case, at the bottom, you can also check off to include the incumbent targeted fund series in case that's what's considered to be as an aggressive or conservative, just not shown on the list, so you can have that included as well. Once you check off all the targeted funds that you want to show, you'll just go to step 3, which is to build the actual report. These reports are the same as any other report that you'll build in the system, so nothing different there. Just as usual, we have our own standard template within the RPAG portal, but as usual, you can continue to do a custom template as well. This is another slide that is in the report as well. This is just looking at the contribution rates from participants. We do find that contribution rates is one of the most telling factors as to whether or not a participant will be funded correctly. And so we have a certain level of risk level depending on the contribution rates. So in this case, for participants who may be contributing less than 6%, they would be best fit for the aggressive risk posture. For someone contributing between 6 to 12%, we feel that they can de-risk a little bit, and they can afford to do so with their higher contribution rates and would be better fit for a moderate glide path. And lastly, for participants who are contributing greater than 12%, they would probably best be fit for a conservative risk posture, just because through their own contributions, they should be able to reach their retirement goals and basically hope for stability. Another thing that we like to use this slide for, or this screen for, is really just to use it as an objective measure as to whether custom multiple glide path targeted funds may be necessary. In which case, a plan like this, it may be prudent to take a look at it, just because although over half of the participants are technically best fit for a moderate risk-based glide path, there's still 48% of other participants who are better fit for either aggressive or conservative. So on the flip side, you may run into a plan where majority of the clients are best fit for a single risk glide path, to where it may not be as necessary if they're a homogeneous group. It's not as necessary to look at the multiple glide path solutions, but it's still there in case you'd like it. So at the end of the day, just with the prevalence of targeted funds out there, we find it extremely important to conduct proper due diligence on the fund itself. We would recommend that for current clients, you'd run the plan fit analysis at least every 3 to 5 years, just to make sure that as participants come and go, or maybe there's mergers and acquisitions within the plan itself or the company itself, the targeted fund that's still chosen is still suitable. The Targeted Fund Analyzer tool is in the RPAG system and can quickly run these fit analysis for you, but our team is still happy to run the manual version in case you want to get the new testing before we get it fully coded into the system. And so that's all I have for you all today.